A guy named Marcus shows up to his accountant's office in mid-January with a folder full of pay stubs, coffee-stained and wrinkled. He's been working 60-hour weeks at a logistics company for 2 years. Overtime was mandatory, not optional. He'd heard about this no tax on overtime thing that passed last summer, did the mental math, and convinced himself he was getting a $3,000 refund. The accountant opens the folder, looks at the W-2, looks at the pay stubs, looks back at the W-2, then slowly closes the folder and asks Marcus if he's ever heard of something called modified adjusted gross income. Marcus has not. The accountant then asks if Marcus knows the difference between the overtime premium and total overtime pay. Marcus does not. By the end of the meeting, Marcus realizes he owes $400 more than he thought, and the refund he'd already mentally spent on a used fishing boat doesn't exist. Somewhere in the middle of all that, the accountant mentions that the W-2 didn't break out overtime at all, which Marcus didn't know was a problem until right then. Now you might be thinking, this is just one guy who didn't read the fine print, but here's the uncomfortable truth. The no tax on overtime provision that sailed through with the One Big Beautiful Bill Act back in July of 2025 is a masterclass in political marketing meeting administrative chaos. It sounds simple. It is not simple. And the gap between what you think you're getting and what actually shows up on your tax return is where a lot of people are going to get very frustrated very quickly. Here's what I'm going to explain today. How this deduction actually works, why your payroll department might be setting you up for a headache, the specific mistake that's going to cost people thousands of dollars this filing season, and the bizarre incentive structure this creates for workers and employers. We're going to walk through the math, the forms, and the quiet little details that nobody put in the press release. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Let me tell you about a farmer who planted 3 fields. In the first field, he planted wheat. Standard crop, predictable yield, sold it at market price, paid his taxes, moved on with his life. In the second field, he planted something called bonus wheat, which the local lord had declared tax-free as an incentive to produce more. The farmer worked harder, harvested more, brought it to market, and discovered that tax-free meant something slightly different than he'd assumed. The third field, he left it fallow, because by that point he'd realized he needed to actually read the proclamation before planting anything. This farmer's name was Thomas, and he lived in 14th century England. But the same exact thing is happening right now with overtime pay in 2026. The wheat is your regular wages, the bonus wheat is your overtime, and the proclamation nobody read is Schedule 1A. Here's how this is supposed to work in theory. The One Big Beautiful Bill Act, passed July of 2025, created an additional deduction for certain types of income that were previously fully taxable. Overtime pay, tips, Social Security benefits for people over 65, and interest paid on car loans. For overtime specifically, if you qualify, you can deduct up to $12,500 as a single filer, or $25,000 if you're married filing jointly. Sounds straightforward. The problem is that if you qualify is doing a tremendous amount of heavy lifting. Let's start with the income thresholds, because this is where the first wave of people get filtered out. If you're a single filer, your modified adjusted gross income needs to be under $150,000 to take the full deduction. Married filing jointly, under $300,000. Head of household, same $150,000 threshold. If you're married filing separately, you don't qualify at all, 0. The provision explicitly excludes you. Now, if your income is above those thresholds, but not too far above, the deduction phases out gradually. But if you're substantially above, the deduction disappears entirely. The phasing out formula isn't even worth getting into, because by the time you're in phase out territory, you've already lost the headline benefit that made this policy sound good in the first place. A friend of mine, let's call him David, works in IT consulting. He's classified as non-exempt, which means he's eligible for overtime under the Fair Labor Standards Act. Good so far. In 2025, he had a stretch from April through September where his team was underwater and he was consistently pulling 55 to 60-hour weeks. His base salary is $90,000, But with overtime, he cleared about $112,000 for the year. Under the income threshold, check. Has overtime pay, check. Files taxes as single, check. All the boxes looked green. He sat down to do his taxes in late January, pulled up his W-2, and realized very quickly that nowhere on that form does it say how much of his income came from overtime versus regular hours. Box 1 shows total wages. That's it. No breakdown, no overtime line item. This is where the farmer from 14th century England leans forward in his chair and says, I told you to read the proclamation. The W-2 form, which every employer is required to send out by January 31st, does not have a dedicated box for overtime pay. There's box 14, which is technically labeled other, and some employers voluntarily put overtime totals there, but they are not required to do so. The IRS created a new form called Schedule 1A, specifically to capture all these new deductions, including the overtime deduction, but they didn't simultaneously require employers to report overtime separately on the W-2 for tax year 2025. Starting in tax year 2026, employers will be required to break out overtime pay on the W-2, but for the 2025 tax return that you're filing right now in early 2026, that requirement doesn't exist yet. So here's the situation. You have a deduction available to you. You have a form to claim it. But the primary tax document your employer sends you doesn't tell you how much you can deduct. You need your final pay stub from December to see the year-to-date overtime totals, assuming your pay stub even breaks that out clearly. Some payroll systems do, many do not. And if you've already thrown out your pay stubs, or your employer uses a system that only keeps them available for 90 days, you might be out of luck. This is what I mean when I say political marketing meets administrative chaos. The policy announcement sounded great. No tax on overtime. Who's going to argue with that? But the implementation created a paperwork gap that benefits nobody except people who are obsessive about record keeping. And even they're going to have a headache. Now let me explain something that I think a lot of people missed. The deduction doesn't apply to 100% of your overtime pay. It applies to the overtime premium. Let me walk you through the math, because this is where Marcus, the guy from the beginning, got burned. Let's say you make $30 an hour in a non-exempt position. That means you're entitled to time and a half for any hours worked over 40 in a week. Time and a half on $30 is $45 per hour. If you work 50 hours in a week, the first 40 hours are paid at your regular rate of $30, totaling $1,200. The extra 10 hours are paid at $45 per hour, totaling $450. Your total gross pay for that week is $1,650. Here's a question. How much of that is your overtime premium? The overtime premium is the extra $15 per hour, not the total overtime pay. You would have earned $30 per hour for those 10 hours regardless. The premium is the additional $15 that time and a half gives you. So on 10 hours at $15 extra, your deductible overtime premium is $150 for that week. Not $450. $150. Do you see the problem? When people hear no tax on overtime, they mentally calculate based on their total overtime earnings. But the deduction only applies to that premium slice. Over the course of a year, if you work consistent overtime, this adds up to real money, but it's a fraction of what most people are expecting. Let's do a full year example. Sarah is a registered nurse in Ohio. She makes $42 an hour as her base rate, and she works an average of 8 hours of overtime per week. That's 416 overtime hours per year. At time and a half, that's $63 per hour for overtime. Her total overtime gross pay is about $26,200. But her overtime premium is $21 per hour, which is the difference between her base rate and her overtime rate. 416 hours at $21 per hour is $8,736 in deductible overtime premium. That's what she can potentially deduct if she qualifies. $8,700 is not nothing. But Sarah heard no tax on overtime and thought she might be deducting $26,000. The gap between expectation and reality is where frustration lives. Now here's where it gets really interesting. The deduction caps out at $12,500 for single filers and $25,000 for married filing jointly. So even if your overtime premium exceeds that amount, you can't deduct more than the cap. For most hourly workers, this won't be an issue. But for someone working substantial overtime in a high-paying trade, that cap becomes relevant. A journeyman electrician in California making $55 an hour base who works 20 hours of overtime per week would hit that cap pretty quickly. Run the math. 55 base, time and a half is $82.50 per overtime hour. Premium is $27.50 per hour. 20 hours per week times 52 weeks is 1,040 overtime hours. Times $27.50, premium is $28,600 in premium alone. But the cap is $12,500. So more than half of that premium isn't deductible. But you might be thinking, okay, the deduction is smaller than I thought, there's a cap, and I need my pay stubs. Annoying, but not exactly a disaster. And you'd be right, except for the part where this creates truly bizarre incentives. Imagine two workers, worker A and worker B. Same job, same hourly rate, same total hours worked. Worker A is classified as non-exempt and gets paid overtime for anything over 40 hours. Worker B is classified as exempt and gets a salary with no overtime pay, but also has to work the same extra hours. Worker A gets a tax deduction on their overtime premium. Worker B gets nothing. Same work, same hours, different classification, different tax treatment. The policy rewards a specific legal categorization, not actual work effort. Or, consider this. You're a worker on the edge of the income threshold. Let's say you're single and your modified adjusted gross income is around $140,000. You've got some overtime this year that could push you over $150,000. Do you take the overtime hours? If you do, you might lose the deduction entirely. If you don't, you leave money on the table from potential overtime pay. You're now doing tax planning based on hypothetical phase-out ranges that you can't precisely calculate until the year is over. It's like trying to hit a moving target while blindfolded. A construction foreman I know, let's call him Victor, turned down overtime in November specifically because he was worried about crossing the threshold. He'd done the math, realized he was close, and decided it wasn't worth risking the deduction. Turns out he miscalculated his modified adjusted gross income by about $3,000 because he forgot about a small dividend payment from an old investment account. He would have stayed under the threshold even with the overtime. He left about $4,000 in overtime pay on the table to protect a deduction he would have kept anyway. This is what happens when you create complex phase-out rules. People make decisions based on fear of crossing invisible lines. Now I want to talk about something else that's hiding in plain sight. This deduction is temporary. The current law only makes it available for tax years 2025 through 2028. That's 4 years. After that, unless Congress acts to extend it or make it permanent, the deduction goes away. 4 years sounds like a long time, but in tax planning terms, it's a blip. If you're making career decisions based on this deduction, you're building on quicksand. Think about it this way. Let's say you're considering a job change. Job A offers a lower base salary, but lots of guaranteed overtime. Job B offers a higher base salary with no overtime. Under current law, Job A looks slightly better from a tax perspective because you can deduct the overtime premium. But 4 years from now, that advantage disappears. Are you going to switch careers again? Probably not. You're making a long-term decision based on a short-term tax provision that could change with the next election cycle. This is where the systems thinking part comes in. When you analyze tax policy, you can't just look at what it does today. You have to look at what incentives it creates and how those incentives shift behavior. The no tax on overtime provision creates an incentive for workers to seek overtime, for employers to reclassify workers as non-exempt, and for everyone to pay closer attention to pay stubs. But it also creates confusion, administrative burden, and a false sense of financial benefit that doesn't match reality for many workers. The farmer from 14th century England would point out that the lord who promised tax-free wheat probably wasn't trying to deceive anyone. He just didn't think through the implementation details. The farmers heard tax-free and stopped reading. The scribes who wrote the proclamation knew there would be forms and verification steps, but nobody told the farmers. Same thing here. The politicians who passed the One Big Beautiful Bill Act weren't lying. There really is a deduction for overtime pay. But the gap between the headline and the fine print is where people get lost. Let me give you a concrete case study that ties all of this together. Derek works as a warehouse supervisor in Texas. He's classified as non-exempt and makes $28 an hour. In 2025, his facility went through a restructuring, and he ended up working substantial overtime for about 6 months. His total gross income for the year was approximately $72,000, which included about $8,000 in overtime pay. He files single and rents an apartment, so no mortgage interest deduction. He takes the standard deduction like most people. When Derek heard about the no tax on overtime provision, he did some quick mental math. $8,000 in overtime. He's in the 12% marginal tax bracket. That's about $1,000 in tax savings. He filed his taxes in early February using one of the major software platforms. The software walked him through the new Schedule 1A, asked about his overtime pay, and he put in $8,000. The software accepted it, calculated his refund, and showed him a number that looked about right. But here's what Derek didn't know. The software didn't ask him whether that $8,000 was his total overtime pay or his overtime premium. He put in the total. The correct number should have been about $2,700 in premium. Derek accidentally claimed a deduction about 3 times larger than he was entitled to. The IRS systems will probably catch this eventually, but maybe not. Their matching algorithms aren't set up for this because employers aren't required to report overtime separately. Derek might get away with it. Or he might get a letter in 18 months asking for documentation he doesn't have because he threw out his pay stubs. This is the mistake I reference in the title. Not understanding what you're actually allowed to deduct, not having the documentation to prove it, and not realizing that the burden of proof falls entirely on you. The IRS doesn't have a magic database that tells them how much overtime you worked. They have your W-2, which shows total wages. If you claim an overtime deduction, you're the one who needs to back it up. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now I want to circle back to something I mentioned earlier. The W-2 reporting requirement changes for tax year 2026 and beyond. Starting with the W-2S you'll receive in January of 2027, employers are required to break out overtime pay in a specific box. This solves part of the documentation problem, but it doesn't solve the premium versus total problem. The W-2 will show total overtime pay, but the deduction still only applies to the premium portion. You or your tax preparer will still need to do the math. And that math gets complicated if your overtime rate varies. Some employers pay double time for holidays or Sundays. Some have different rates for different types of overtime. The premium calculation changes depending on what your base rate actually is. If you got a raise mid-year, your premium changes. If you worked overtime during a period when you were receiving shift differential pay, that might affect the calculation. The simplified examples I'm giving you assume a clean hourly rate with straightforward time and a half. But real-world payroll is rarely that clean. Here's a quick comedic cutaway for you. Picture a CPA at a tax preparation firm trying to explain to a client that their tax-free overtime deduction requires calculating the delta between base rate and overtime rate across 52 pay periods with 3 mid-year raises and a shift differential that only applies on weekends. The client's face goes blank, the CPA sighs, someone in the background whispers, "This is why people hate taxes." The other provisions that rode along with the overtime deduction have their own quirks. The no tax on tips provision applies to tipped employees, but it has similar income thresholds and requires the tips to be reported on a W-2, which not all employers do correctly. The Social Security deduction for people over 65 is an additional deduction on top of the existing Social Security benefits, but it phases out too. The car loan interest deduction only applies to vehicles purchased after a certain date and has its own income limits. Every provision in this bill has a specific target audience, and if you don't fit that target, the benefit either shrinks or disappears entirely. Another quick cutaway. A guy walks into a tax office and says, "I heard there's no tax on overtime now." The tax preparer looks up and says, "There's a deduction for the overtime premium if you meet income thresholds and have proper documentation. But technically, no tax on overtime would require a fundamental restructuring of the tax code. So really what you have is a partial deduction with strings attached." The guy stares for a moment and says, "So, is that a yes or a no?" The people who designed this policy understood something important about human psychology. If you call something no tax on overtime, people will hear no tax on overtime. They won't hear partial deduction for premium portion, subject to income limits, and documentation. Requirements. They'll fill in the gaps with their assumptions, and their assumptions will almost always be more generous than reality. This is the same psychology that makes sale signs effective, even when the sale price is higher than the regular price at a different store. The framing does the work. For those of you who are still with me, let me give you the 3 practical takeaways that will actually matter when you sit down to file. First, gather your final pay stub from December of 2025 before you even think about filing your taxes. That pay stub should show year-to-date totals for regular pay and overtime pay. If it doesn't, contact your payroll department now and request a detailed earnings statement. Do not assume your W-2 will have this information. It probably won't for tax year 2025. Second, calculate your overtime premium correctly. Take your overtime hours for the year, multiply by the difference between your overtime rate and your regular rate, and that's your deductible amount. If you're not sure how to do this, ask your payroll department for a breakdown or consult a tax professional. Do not just plug in your total overtime pay and hope the IRS doesn't notice. Third, check your modified adjusted gross income against the thresholds before you get your hopes up. If you're a single filer making over $150,000 or a married couple filing jointly making over $300,000, your deduction is reduced or eliminated. And if you're married filing separately, you don't qualify at all. These thresholds aren't suggestions. They're hard cutoffs with phase-out ranges that can get mathematically ugly. Lazy investing built more fortune than crypto memes, and understanding the actual mechanics of tax deductions builds more wealth than believing political headlines. The no tax on overtime provision is real. It's available. It can save you money if you qualify. But the gap between the marketing and the mechanics is where people get tripped up. Don't be Marcus walking into his accountant's office with coffee-stained pay stubs and a phantom refund in his head. Read the fine print. Keep your records. Do the math. And maybe next time a politician announces a new tax benefit, wait for the implementation details before you plan your spending.